All right, today we are going to dive into one of the wildest times in market history, the dot-com bubble. And we're going to use the timeless wisdom of the investing legend Benjamin Graham to cut through all the noise. Why? Because we want to uncover one single powerful lesson that is just as critical for your money today as it was back then. Let's get into it.
You know, the great Yogi Berra really hit the nail on the head with this one. When it comes to investing, if you're just wandering around without a map, without a clear, disciplined strategy, you are almost guaranteed to end up somewhere you really don't want to be. And believe me, back in the late 1990s, pretty much everybody got spectacularly lost.
So what was this siren song that lured so many investors onto the rocks? Well, it was a really simple, incredibly seductive, and ultimately a disastrous piece of logic that completely took over Wall Street. This right here. This was the absolute core of the bull market baloney. It wasn't just that stocks had delivered about 7% a year since way back in 1802. The truly dangerous part was the assumption that this was some kind of law of nature. Yet experts, best-selling books, all misusing this one statistic, turning it into a promise. 7% returns, guaranteed, forever. And this single, flawed idea set the stage for a truly massive collapse.
So let's take a look at what the so-called experts were shouting from the rooftops right at the peak of all this mania. I mean, it is a masterclass in what Benjamin Graham would call heedlessness.
So here we have a fund manager. It's December 1999, and he's looking at tech stocks trading at prices so high they were completely disconnected from reality. Some of these companies had no earnings at all, and he just declares it's not a mania. He was completely hypnotized by growth, but totally ignoring the astronomical price he was paying for it.
Okay, so a month later, a chief strategist tells the Wall Street Journal it's a new world order, and that worrying about a high stock price is the worst mistake an investor can make. I mean, wow. This is the classic and always dangerous, this time is different argument in its absolute purest form.
And this one might take the cake. This perfectly illustrates the peak of the insanity. A chief strategist at a huge firm, asking if higher prices mean more risk, and then confidently answering no. He was literally arguing that up was down and black was white. But as Graham's principles always teach us, the market always gets the final say.
So, how did all this advice pan out? Well, it was catastrophic. The fund manager's pet stock, Winstar, it lost 99.9% of its value. Gone. The strategist's favorite, Cisco, lost over 70%, wiping out more than $400 billion in value. And the overall NASDAQ market? It imploded, collapsing by over 70%, completely erasing 6 years of gains. All right, so let's move on to the second myth that was fueling this whole dot-com bubble. The idea that, in the long run, stocks are just guaranteed to win. And this belief wasn't just simple optimism. It was actually based on a fundamental misunderstanding of history.
The flaw in the logic has a name. It's called survivorship bias. See, when you look at long-term stock market history, you're only ever seeing the winners, the companies that actually survived. You're completely ignoring all the ones that went bankrupt and just vanished from the data.
And what's kind of funny is when you look at some of these thousands of companies that went bust and were just erased from history, you got to appreciate the names. For every success story, there were countless disasters, like the wonderfully named Dismal Swamp Canal Company. I mean, seriously, would you invest in that? So here's the crucial point. Once you adjust for all those failures, the picture changes a lot. That myth of 7% annual gains, easily beating bonds, it just evaporates. The reality is, early stock returns were overstated by at least 2 percentage points. In the real world, stocks did no better than cash or bonds.
So, if you can't rely on the past repeating itself, what can you rely on? Well, this brings us to the ultimate antidote to all the bull market baloney, Benjamin Graham's central, unshakable principle.
It's really that simple, but it's also that profound. A great company can be a terrible investment if you pay too much for it. This was the lesson that was learned so painfully during the dot-com bust. Because a company's profits are finite, the price you should be willing to pay for it also has to be finite.
This analogy is just perfect. Michael Jordan was the greatest basketball player of all time, right? The GOAT. But there is a price where even the greatest becomes a bad deal. Nobody would have paid him $3.4 billion for one season, because it's just an irrational price. It's completely disconnected from the actual value, the ticket sales, the merchandise that he could possibly bring to a team.
The exact same logic applies to stocks.
And this is the cost of forgetting that rule. $7.41 trillion. That's how much wealth just vanished, vaporized, when the market finally remembered that price does in fact matter. A brutal lesson for sure, but a necessary one in the laws of financial gravity.
Okay, so we've torn down the myths, we've seen the wreckage. Now, let's build something solid in their place. What's Graham's actual, practical advice for the everyday defensive investor like you and me?
First up, and this is pretty radical, Graham says to forget about your age. I know, conventional wisdom tells a 25-year-old to be 100% in stocks. Graham says no. The real risk isn't in your portfolio, it's in you. Can you stomach a 50% crash without panicking and selling everything at the absolute bottom? Your behavior, not your birthday, is what should determine your strategy.
So where do you start? With this dead simple 50-50 split. Half your money in a diversified basket of common stocks, the other half in high-quality bonds and cash. See, this isn't about predicting the future. It's about building a portfolio that can withstand the future no matter what it decides to throw at us.
And here is the real genius of the system, a simple mechanical rule for rebalancing. When stocks do really well and grow to 55% of your portfolio, you automatically sell a little and buy bonds. When stocks fall to 45%, you do the opposite. This forces you to do what everyone knows they should do, but almost no one has the discipline for: sell high and buy low. It completely replaces emotion with simple arithmetic.
So this really brings us to our final thought. The intelligent investor doesn't try to guess what the market's going to do next. They don't have a crystal ball. Instead, they build a system that reacts calmly and rationally to whatever the market does. So take a hard look at your own strategy. Is it built on prediction or is it built on discipline?
And we'll end on this powerful idea from G.K. Chesterton. By lowering our expectations for crazy future returns and just focusing on a disciplined process, we free ourselves from all the anxiety of the market's day-to-day madness. We stop chasing the impossible and we start enjoying the peace of mind that comes from a sound, timeless strategy. Thanks for listening.